My name's Peter Hewitt, and as it says on the slides, I'm head of European tax practice with Fiscal Reps. And this is Elliot. It says on the slides he's an IPT specialist, but actually he does all sorts of taxes. He does gambling taxes and VAT and all sorts of things. So, jack of all trades. What we're going to do is, rather differently from last year when we had a VAT on claims costs session, we're going to run through some of the non-EU countries who impose VAT on insurance and have a look at the way claims costs are dealt with there, because it's quite interesting. Hopefully it's relevant as well. It may not be, but it's still very interesting. And we've got Nick Marman who's joined us here, and who knows an awful lot about it too.
No,
so
I don't.
If there's something we don't know.
Ignorant about it.
Nick's from Lloyd's, as you probably know, very well known man. And Elliot is going to do that one. If we have time, I will have another look at what we talked about last year, which is the way claims costs are dealt with in the UK, the way HMRC are approaching it, or not approaching it anymore. But that's only if we have time, so it depends how much discussion we have on the first session, which is, as I say, the most interesting one, and the one that Elliot's been researching. So over to Elliot.
Well, I hope you jump in, Peter, if you want to. So there's a small background to VAT. VAT is a form of consumption tax and is essentially a tax on the value added at each stage of a supply chain. Most countries have some sort of VAT, otherwise known as GST, Goods and Services Tax, in other parts outside of the EU. Rates vary throughout the EU, and businesses
Possibly the lowest rates in Malaysia, is that right, Nick?
Is it 7.5 or 5? I can't remember.
It's 6.
Six,
yeah.
okay.
That's reasonable.
You're not going to do this all the time, are you?
Oh yes.
What did I do in the previous slide?
Feel free if you want to.
Oh, don't worry.
You're going to earn your beer today.
So businesses register for VAT, so they're able to reclaim the VAT on their purchases, or otherwise known as input VAT. So some services are exempt from VAT in the UK, insurance being one of them, although other taxes are levied on insurance premiums. IPT is in the EU. So in jurisdictions outside of the EU, GST or VAT is actually levied on insurance premiums. And we'll talk about a few of those tax systems, later on. So here's some EU VAT rates. Luxembourg has the lowest rate in the EU at 17%, and Hungary has the highest at 27%. The average rate, I believe, is 21.6, so somewhere between 21 and 22.
I thought the rate in Europe was only allowed to go up to 25. Show my age
That's
and data.
an old rule.
Oh, right, okay.
In fact, I think Hungary was trying to increase to 29, but they didn't get away with it nationally.
So is there a cap on the maximum rate now?
None at all, as I understand it. There is a minimum, that's 15.
Sorry.
So the UK standard rate sits just below the average at 20%. They also have a reduced rate of 5%, which applies to certain domestic fuels and heating products, some residential building works, and other goods in a public interest. The zero rate applies to food and some drinks, aircraft and ship manufacturer, and also residential building works as well. Export of goods are zero rated. Zero rate differs from an exemption in the fact that the zero rate is a taxable supply, whereas an exemption is not a taxable supply. So with a taxable supply, you're able to claim back your input VAT, whereas on an exception you can't. So As we previously mentioned, insurance is exempt from VAT in the UK, but there are also some financial and many health services that are also exempt. As I said, in some territories outside the EU, VAT is charged on insurance, or GST, as New Zealand, Australia, Singapore and Malaysia have a GST system, whereas South Africa has a VAT system. Malaysian rate of 6% was introduced this year, 1st of April 2015, and the rates are generally lower in Asia and Oceania compared with the EU.
Can I just add something here? What's really interesting about New Zealand and Australia is that they've both introduced the concept of taxing non-resident suppliers. Principally, it's to address electronic goods services being provided into the country to individuals, non-registered individuals. But it also seems to capture insurance. So if you're writing personal lines business into either Australia or New Zealand, potentially you will have a liability to register. New Zealand issued a consultation recently and it closed a few months ago. We submitted something to that. So it's still sort of not set, but I believe in Australia they've actually formalised the legislation, and it will pose some problems for people writing personal lines into those jurisdictions, because potentially you're going to have to register, even though you're not a resident entity.
What's the effective date of that?
Australia's 17, I believe, and New Zealand, they're drafting their legislation as we speak, so we don't have much time to persuade them. I think
South Africa's already introduced it.
South Africa's got I think they've got a reverse charge principle. I don't think they've got any. Do they have anything on?
They were
personal
talking
lines?
about it, and I think they were ahead of Australia and New Zealand, but I think probably they either have introduced it or it's going ahead in January.
Well, the other thing, which
So
it's
whether the same problem occurs in South Africa, I don't know.
well, what's relevant
Regards insurance.
now is if anybody noticed something the OECD published, I think it was on the 4th or 6th of November, or something last week anyway, in relation to indirect taxes. They are, it's the basic principle of if you're a non-resident entity providing services to private individuals in another jurisdiction, then they want to tax you or tax that service in that jurisdiction where the individual is, which means inevitably you're going to be brought into the tax net, even if you're a non-resident, which is a change in the basic principles of sales taxes and consumption taxes, is that for businesses there's a reverse charge, and for personal lines it's just ignored. We're moving away from that model, which is unfortunate, particularly where you've got GSTs and VATs on insurance.
And Bahamas is introducing VAT.
They have.
They have, but not on insurance yet, I think, isn't it?
No, it came in July,
Yeah.
unfortunately.
And
Yes.
they have a slightly different system for taxing personal lines, don't they, as I understand it? At least that was the plan.
We've taken some advice, and I don't actually agree with our advisors, which is awkward. But there, I believe that non-residents shouldn't be brought into the net, because rather like the good old Schedule 5 services, that's the trigger for determining whether something's reverse chargeable or not. Or whether your service, the place of supply, is brought in to Bahamas. It's at the moment it's too early to say, but I suspect if you've got a license in Bahamas, at the moment their trigger is you've got a business license, but I think they've missed a trick, and they'll realise that if you've got an insurance license, you're in the same boat, that will bring you on shore and you'll become liable to be registered. Unfortunately, we've got a license in Bahamas, but fortunately it's a nice sunny place.
Yes. Anybody else with a license in Bahamas? Unfortunately not. Thanks, that's useful.
How about South Africa? So the VAT rate in South Africa, the standard rate is 14%, which means that for every 100 Rand of premium, there's 14 Rand to be remitted. Long-term insurance premiums are exempt, like life insurance, whereas short-term general insurance premiums are charged at the general rate. So insurers remit output tax at the standard rate, and insurers are eligible to claim input tax credits on indemnity payouts, subject to a few exceptions. If the contract of insurance was initially not a taxable supply, if it was zero rated and the insured is not a business, and if the payment is made to someone outside of South Africa. So the insured is liable to remit output tax on the indemnity payment if they are registered.
Yeah, so if you've got an insured who's GST or VAT rather registered in South Africa, the tax just goes round and round in a big circle, which is the right result in the VAT system. If they're not registered, then potentially the insurer gets the right to an input tax credit, even though there's no equivalent output tax paid by the insured, because they're a private individual or whatever. Which is interesting. I mean, that's the theme that runs through all of what we're saying today, is that the intention in a VAT system is to tax the value added, and the value added in insurance is the difference between the premium and the payout. That's where it differs from a premium tax. Premium tax simply taxes the premium, and therefore it gives the tax authority a bigger yield.
So New Zealand has taken a similar approach to South Africa. Their GST rate is 15%. Life insurance is also exempt, and general insurance is taxable at the standard rate. Input tax credits are available on settlements of general insurance contracts, but not on life insurance. And the input tax credit value is 3/23 of the settlement amount.
That's because it's a tax-inclusive settlement, basically, so it's 1,515 rather than 15%. Anybody who's dealt with VAT in the UK in the past has probably got used to that fraction, 3/23.
So a GST registered insured needs to remit output tax on their indemnity payout, unless, as I said, it's a life insurance contract or the payout relates to loss of earnings, for example, accident compensation. When we move on to Singapore, who've done things slightly different. They've simplified the tax system compared with South Africa and New Zealand by essentially removing the input and output liability on settlement payouts. So for a GST registered insured, there's no output tax liability for that insured, and the insurer is unable to claim an input tax credit on the settlement payout, except on medical and accident insurance and costs, as well as motor cars.
The reason for that being that the costs associated with those are not deductible, they're blocked. So therefore it's like a private individual personal life arrangement. It's only where the insured can recover the GST on the costs that you don't have any output tax liability.
And similarly, if the insured is not GST registered, for example, an individual, the insurer can claim that an input tax credit to the value of 7/107 of the payout. So Singapore effectively removed the extra
roundabout
transactions on the payout amount. It just happens at
I mean, the danger is if you have, it's probably best to go on the next slide actually, because we've got the diagram that shows this, but if you have this output tax liability, the insured receives a payout, how's he to know that he's got to pay output tax on that? It's not logical in my mind. Insurance payout is not payment for a supply, and therefore it shouldn't strictly be subject to a VAT or GST regime. But in South Africa it is. In Singapore, authorities have just said, well, why are we doing that? We're just going to lose all this tax if we're not careful. So we'll just ignore it.
Isn't there a fundamental problem with this? I mean, VAT is a charge on a supply.
Yeah.
So they're deeming a claim settlement as a supply. I mean, fundamentally, that doesn't sit Right.
Doesn't seem right at all. Absolutely.
Also, I mean, I know there are people out there advocating that the EU should abolish the exemption, certainly for general insurance, and charge VAT on it. I hope this is an education just how horrible it could become. So you're not going to, you might be able to forget partial exemption, but you're going to have all this to deal with. And one of the challenges I'm facing is how to implement these regimes where you've got a co-insurance market, and what's more, you've got multiple syndicates on a risk. So this is just a nightmare, whichever way you go. So I actually like premium taxes because they're a simple tax. They're a tax on a transaction. You know the facts at the outset. The difficulties arise in, say, location of risk and stuff like that. But even here, you've got to, with GSTs and VATs, they won't run to the same rules. So potentially you could have a risk which is subject to premium taxes in a jurisdiction, and also GSTs in another jurisdiction, simply because of the nature of the facts. Life's going to get complicated.
Yeah, I mean, this example, it gets even more complicated if the payout's not to the insured, but to a third party, of course. Third party gets paid, the insured is still liable to pay the output tax to the tax authority, even though he hasn't had any money. So it gets even more complicated. And obviously they're going to miss it in some cases. The insurer won't miss it because he's made the payout, so he'll have his input tax deduction. But I suppose the more logical way to think about it is that what they're aiming at in all these jurisdictions is to tax the value added, and that's what a value added tax is all about. And with an insurance contract, the value added is the premium less the claims, basically. So this is a way of doing it, but it's a very awkward way, frankly, and does create a lot of difficulty.
It's an artificial. I don't see that as a value added.
Yeah, I mean, when we come on to look at the Australian system, they have perhaps got it a little bit easier. They've simplified it, and so it's not quite such a monster as these systems are. But even so, it's complicated.
Yeah. So Australia, they initially adopted the New Zealand system, but after a few modifications for greater administrative efficiency for themselves, they replaced input tax credits with a decreasing adjustment method. There's no output tax or input tax on settlement payouts. Rather, you just decrease the amount of output tax that you're liable to pay. So here's an example. So the insured has paid the insurer premium plus GST of $121, which makes up $110 of premium and $11 of GST at 10%. So the insurer's output tax liability is $11. After a settlement of that claim, the payment is made inclusive of GST of $99. So the amount of GST on that claim is $9. Therefore, the decreasing adjustment is $9, and they're able to reduce their $11 output tax liability by $9. Effectively giving net GST of $2, which is, so the premiums minus the difference between the premiums and the payout is 22, which is inclusive of GST. So work back from the tax fraction, you also get $2.
Well, that's a funny example you've given there, because it's not bad business if the claim comes in under the premium. But generally, my experience is the claim comes in way over the premium. In that case, are you saying the Australians give us some money back?
You look at it on a global basis, obviously, is the way this works. Actually, it's an interesting question. If your overall claims are more than your overall premiums, do you get a credit? I'm not absolutely sure about that.
Well, you must have,
answer to
surely.
that. Well, it's a reduction of output tax. That's the difference between this system and the South African
So you're
system.
saying once you've reduced your output tax to zero, you don't
can't
get
reduce
money
it anymore,
back?
potentially,
Oh,
yeah.
that doesn't seem fair.
But it is a bit more logical, I think, than saying there's a supply by the insured to the insurer, or by a third party to the insurer, or anything, because there just isn't, is there? So it doesn't fit well in a VAT system.
very simplified set of transactions. This is another example. Potentially a bit too confusing. You might come up with a simpler one.
Yes. Oh, I forgot to get the handouts. Sorry about that. I'll go and get it. Explain that if you can.
Well, okay. So this example, an insured is eligible to claim partial input tax credit of 40%. And the insured suffers a loss and is paid the settlement of $2,120. Now, to calculate the amount of GST liability that the insurer is able to reduce their liability by, there's a two-step calculation. The first step is to calculate what they call the settlement amount, which effectively grosses up the settlement payment to 100% input tax credit by sort of reversing out the 40% input tax credit that the insured is eligible to claim. The second part is to then calculate how much the insurer is able to decrease its adjustment by. So it uses the percentage that the insured is not able to claim multiplied by the settlement amount to get the amount they're able to reduce it by. We do have a slightly more simple example. 1C has this example, shown a bit clearer. So the insured can claim back 40% of the GST amount, which from the overall settlement amount of $2,200 will be $200. So their input tax credit is 80, meaning that the insurer is able to claim back 60% of that 200, which is their 120.
This is where it gets a bit more complicated, unfortunately, when the insured is partially exempt. And quite what happens if it's a third-party claim, I'm not 100% sure. But the idea of this calculation is to allow a credit to the extent that the VAT is irrecoverable on the claim cost for the insured, and no credit to the extent it is recoverable. So again, it's trying to attack the value added in a kind of non-VAT recoverable scenario, like a person who's a private individual. So it's all logical when you look at it, but it becomes incredibly complicated. So I'm with you, Nick. I think I prefer premium taxes.
Yeah, fairly straightforward. So to sum up for those 4 countries, so that the various jurisdictions approach taxation of insurance differently. Their overall intention is to collect VAT and GST on the added value, that being the total collected premiums minus the amount of payouts. And some tax authorities have chosen to simplify the tax collection in various ways.
No, the chap holding the red wheel, he's not going to go anywhere. those spokes are not going to work with the green wheel at all. That's actually just how it feels with the different tax arrangements. They're all subtly different, and they just don't work together. I was just thinking when you go through this, how an insurer will actually build systems to deal with this, where you've got all these different rules. Yes.
Well, at least with the Australian system, the idea is that if there's a claim, the insurer asks what the VAT recovery is, which happens in this country with motor claims and things. Because, I mean, they need to decide on what the claim actually is. If the business can recover VAT, the claim is that much less. So once they've done that, they can then do the decreasing adjustment using that calculation. And at the same time, work out what the settlement is too. So there is a logic to it. unlike South Africa and Singapore and New Zealand and all those other
Yeah.
countries, but there doesn't even seem to be a logic to it, frankly.
Well, I can only see this getting worse. After the OECD, the agreement, it's not going to get better.
Yes. Yeah.
Well, sorry,
So
it's fine for you because you'll be selling the services to
Yeah.
help us
This
sort
is
this
what's
out.
gonna- I mean, there's more and more countries introducing VAT systems all the time, and Bahamas is perhaps the most recent one. Malaysia, perhaps, because I think they were 1st of January with the VAT system. Bahamas, but it's an increasing phenomenon, and those that are introducing VAT systems tend to tax general insurance.
India, China.
Yeah, India and China are coming up, and it looks like China's going to introduce VAT at, what, 11%, I think is the latest news.
Keeps on changing.
Yeah. So, yes, look out for VAT on insurance. It's an increasing phenomenon. Gives rise to all sorts of difficulties. Can you get on to the other presentation? We've got some time left. I thought we might be quite quick on that, so unless there are any other questions, we'll move on to what the heck's happening in the UK and in relation to claims costs, which is something that I covered last year. There hasn't been an awful lot of movement since last year. Was anybody at that presentation last year? No, good. So you're not seeing this for the second time round. I just want to have a quick look at those issues, but particularly related to UK and the way that HMRC approaches claims costs. Obviously, we've talked about the way VAT works. Place supply changes 1st of January 2010 had an implication for this because a lot of the services that make up claims costs had their place of supply changed. The real issue that started this off was way, way back. I think Deutsche Rück was 1984 or something like that. And it was a case where, at the time, HMRC would view claims costs as being partially recoverable, depending on the insurance company's residual recovery rate. And they didn't attribute claims costs to the individual insurance policy, and therefore to either taxable supplies, in inverted commas, or to exempt supplies. Exempt if the policyholder's in the EU, of course, and taxable if they're outside. So you just get your 10% recovery, whatever your residual rate was as an insurance company. Deutsche Rück said, well, look, we've got these contracts with people who are outside the EU. We want 100% recovery, not a residual recovery rate. And they won their case. I think it was a High Court case, if I remember rightly. And HMRC said, well, yes, it looks like that's right. We're going to change our policy. And they issued a business brief, as they were called in those days, which basically said this is what we're going to do from now on. If you've got a claim that relates to an EU policy, you can't have any recovery of the VAT on that claim's cost. If you've got a claim that relates to a non-EU policyholder, then you can have 100% recovery. And you have to therefore identify all of your claims costs to individual policies. It seems as though everybody ignored that business brief completely and just carried on regardless. Either not recovering any VAT on claims costs, which actually I find is quite common, in which case there may be an under-recovery, but there may not, or recovering the residual proportion of VAT on claims costs. Any idea how this works in Italy, Nicola?
Not really, to be honest. I'm sorry. Never
It is.
came across this.
It's very hidden in the UK because the claims system tends to be different from the accounting system, so it's a completely separate cost system, and therefore, the two don't talk to each other. So the VAT return is taken off the accounting system, which doesn't take account of all the claims costs.
Generally, with an insurer, the premium management system will have a flag, which will then. One thing you would want with a claim is to validate that you've got a proper policy and the claim is valid. So there will be linkage through to the underlying policy. And usually with a premium management system, you would have an indicator whether it was outside the scope of recovery or not. That's.
And I think
I wouldn't
exchange
say
can
that's
do
Lloyd's.
that, but they do charge extra, and nobody pays for it, as I understand it.
Well, no, actually, with exchanging, I think there is difficulty with identifying claims costs in themselves.
Right.
in terms of the expenses, because that's what we're talking about here. We're
Yeah.
not talking about the indemnification, we're talking about the actual costs you've
Yes.
incurred
Exactly.
in settling that claim, and that is quite often a difficult thing for an insurer to do. In fact, insurers have always struggled, in my opinion, when I was a VAT officer, and now looking at systems from Lloyd's perspective, they've always had difficulty in identifying those costs within their systems, and generally they use the residual recovery rate.
Mm.
I think it's not because people are ignoring it, I just think that systems are not capable of necessarily giving the right information.
Yeah, I agree. And either they, as I say, use the residual recovery rate, or they just recover nothing at all if there's not going to be a significant amount of VAT recovered. If most of their policyholders are EU, for example, so the recovery rate's quite low. But that's not the end of the story, of course. That's where you've got UK VAT charged on claims expenses. But what if you haven't got UK VAT charged, if it's a foreign cost coming into the UK, legal costs or whatever, and there should be a reverse charge VAT liability. Now, a lot of insurers are not identifying that reverse charge liability, and therefore not accounting for output tax on the legal services that they receive in relation to claims, or other services which are reverse chargeable, Place Supply UK. That is what made HMRC sit up and take notice about 3 or 4 years ago and start investigating insurers for these claims costs issues, and trying to say, well, you failed to account for output tax here, and if it's an EU policyholder, then you shouldn't have recovered input tax. So you owe us the full amount of VAT, 20% on the legal cost, whatever it is. So HMRC are out of pocket. A lot of insurers would have thought, if we just apply the residual recovery rate, we're not going to be far off, or if we recover nothing, we're going to be safe. But actually, that's not the case because of this reverse charge issue. So if HMRC come in and have a look at the accounting systems and start asking about claims costs, it's these costs that they're looking for, not necessarily the VATable costs, but the ones that should have been reverse charged. So residual VAT recovered, no entitlement. Obviously, you've over-recovered to the extent of 10% or whatever it is. They're not quite so interested in that as the reverse charge. But they're not going to point out that you've under-recovered. And they're not going to worry if you haven't accounted for reverse charge on a cost that's come in from the US, for example, where it's a US policyholder. That would be in and out. That would be output tax and 100% deduction of the input tax. So they're not going to be worried and looking for that. It's just where it's EU policyholders that they're interested, because that's where they can make money. Okay, so claims fulfilment costs. We had a look at this last year in some detail, but it's very often the case that the claims cost is not a cost of the insurer. It's actually a cost of the insured, and it's indemnified by the insurer. And if the insured is VAT registered and able to recover all its input tax, fully taxable business, then obviously that's good news. You want it that way around. On the other hand, if it's an insurer cost, like a legal cost, for example, very often, then you can't do that, and it does have to be input tax for the insurer rather. But one of the main rules is, if you can, and if you're talking about business insurance, it's worth having the insured incur the claims cost, the repair, whatever it is, rebuilding, whatever. VAT is then deductible by the insured, and the insurer doesn't have to meet that VAT cost, so it reduces the claim. Same applies to services generally. It can very often be better to have them received by the insured because they can recover the VAT where the insurer perhaps wouldn't. And then you have to think about place of supply when you're looking at services, because places of supply, particularly for land-related services, it's not always straightforward. Land-related services have a place of supply where the land that they relate to is situated. But the difficulty is in distinguishing a land-related service from a non-land-related service. I've actually got a live situation at the moment, which I've written to HMRC policy on, where a lawyer has done some work to establish the title to a building in the UK, but the owner is in the Channel Islands. So the question is the place supply Channel Islands because it's not a land-related service, or is it UK because it relates to the land that they've established title on? And there's a lot of money. I mean, I think they charge £50,000, these lawyers, for this, so it's an important point. And I'm not 100% sure what the answer is. There's lots of guidance on what's a land-related service and what isn't. But this particular example is not in there, so we'll see what HMRC come back with. The dividing line can be quite difficult. For example, my services, if I'm advising on the VAT treatment of land, then you'd have thought that's probably land-related. But no, it's not. It's far enough removed from the land to be just a general rule service. So the place of supply then becomes where the customer is based. And if my customer's in Channel Islands, I don't charge VAT, and there's no reverse charge.
There are other countries have slightly different rules in relation to, so it's not just land. For instance, in Canada, if you have legal services being provided to the underwriter in relation to Canadian risk, the lawyer can effectively zero rate their supply to the UK insurer up until a certain point, and I think it's the point that they go to court, it starts to formalise. So then the services provided by the lawyer after that point are seen to be subject to Canadian GST. So the place of supply changes at a moment in time because of what's happening. So, I mean, the rules are, well, there are as many rules.
The rules have got to keep us in work. It is very, very complicated indeed, yeah. And then exemption for some services as well. This is a really difficult one, particularly just recently because the European Commission has decided to withdraw the financial services consultation and the proposal for amendment to the directive to make claims handling and that sort of service exempt, because the member states just couldn't agree. And of course we had, in, I think it was 2005, the Anderson case, which said, the European Court said, in current EU law, claims handling is not exempt, it's taxable. So the exemption we enjoy currently in the UK is not correct in EU law. But HMRC agreed to leave it in place pending the outcome of this review in the European Commission. And the review has been dropped. So anyone like to guess what's going to happen next in the UK?
I'm not so sure the Revenue and Treasury have got an appetite to attack this.
You think so?
Well, I don't know. It's everything they were trying to do. They were trying to achieve, certainly claims handling to be exempt. That was what they wanted to do. I suspect they might wait until, after all, they're very busy people. There are not many of them.
They also need money.
Yeah, well, they might wait for infraction proceedings or hints of.
Possibly, they might wait until they get a reasoned opinion from the Commission.
I mean, if
Which is the first step, isn't it?
Last time the Commission attacked our position on exemptions was when they looked at the revenues guidance, the public notice, and they picked out a few rather ancient decisions and positions. I can't remember exactly which they were, but they were really far out in terms of the exemption, and said these are not right. You need to change. And so customs or revenue and customs changed their position at that point. So it's been known where the Commission has shown some interest in reviewing UK's position, that then the Revenue Act. So I hope that they will wait until they're pushed or shoved to the point.
Maybe a very gentle push, though, I think, if the European Commission says, well, we've withdrawn this proposal for a directive, what are you going to do now? Because the Commission is quite well aware that the Treasury decided not to implement Anderson because the industry was so upset about it when it first came out.
Yeah, well, you ought to put it into its political timing. What about that's just another arrow in the quiver for those who want to leave the EU. So I'm not completely convinced they're going to poke us with sharp sticks on this just yet.
It'll be interesting anyway.
Next question.
Yeah.
You say may qualify for exemption when for insurance-related service. When may not it apply?
Well, it depends what you're doing. For loss adjusting, basically you don't qualify for exemption. But there is an exception which says you do get exemption if the loss adjuster has the right to settle the claims, delegated authority
Oh, okay, yeah.
to repudiate or settle the claim. So that's really why it's may for loss adjusters. But all of those expert services, surveyors and anybody that's acting in a similar way to a loss adjuster, lawyers do it quite a lot, potentially they are taxable, but they might enjoy exemption at the moment at least, if they've got delegated authority.
Isn't there going to be a change on this delegated authority? Because there was a case, wasn't there, where the HMRC said it was all taxable when they used delegated.
There are dangers where certain so-called intermediaries, I shouldn't say that, claim exemption.
Particularly.
Yes, Foyle comes to mind. Where they really have pushed it. I mean, properly, technically, yes, they've got delegated authority. Yes, they're settling claims, but they're bundling up services, and effectively, in my opinion, they've got too greedy and they bundle up too much. So I think the revenue were comfortable accepting the facts. Yes, they are actually, despite the fact they're lawyers, they are doing claims handling. It's the fact that then there was too much trimmed off the edges of the taxable services, or even taken away completely. And I think that's the biggest danger. I don't think the Commission's danger. I think the danger is where intermediaries serving the insurance market push. And it won't take very much, I think, and it's been our concern for the last 2 or 3 years, that there'll be a case which forces the court to consider Anderson and basically give the revenue nowhere to go. So they get a decision which means they have to act.
Because then you have referred to the acting as an intermediary at Restop and Westonsure, haven't you, from Anders?
Well, Westontsure's ongoing, isn't it? Risk Stop is an interesting one because I think they did consider Anderson in Risk Stop, which was just a first-tier tribunal decision. But they decided that exemption didn't apply, so your worry didn't come to fruition, but it might have done.
I would say those cases, you talk about insurance related there, they are looking at, I think that both those cases would narrow what I think people would think is insurance related or an insurance intermediary.
Yeah.
As you said, I think, so maybe HMRC are looking at narrowing it within the existing law as well.
Without attacking
They are,
true
yeah.
claims handling.
With leaving claims handling, but looking at those other services that are provided under the umbrella of claims handling.
Yeah. I've got a tribunal appeal ongoing myself, actually, which is stood over behind Westontshire, to do with selling on leads. One broker selling a lead to another broker to see if their panel of insurers can meet the needs of that particular business insurance. And there's an old tax tribunal case called Leadex, which said that's taxable. But I think it depends how much you do. If you're passing on a name and address, then yes, it's probably taxable. But if you're passing on name, address, and needs, all the, they've got
You're
a property,
actually
they've
collecting
got a fleet of
information.
cars, they've got X, Y, Z.
That changes it longer and longer with people using the internet to try and buy insurance, because you get eventually at some point the exemption's got to stop, I think, in terms of
Well, there's dividing
yes,
line.
click-throughs and things like that. Yeah.
Well, Google is more advertising, isn't it?
Yeah.
If you click through to an insurer, that's it. But there's no assessment of needs or anything that a broker might do. But if you are doing that and then passing on the benefit of what you've done, to my mind, you should get exemption. It's just like a placing broker and introducing broker, really, isn't it?
Apart from their regulation.
Yeah.
Actually, we should be. I mean, when Anderson came out in 2005, I remember sitting in meetings thinking, well, that's it. It's all over. I was quite.
I think everybody thought that at the time.
And here we are, 5 years later. 10 years later. Time flying. 10 years later, and still we enjoy what is quite a wide exemption in the insurance. Well,
Yeah, but HMRC certainly do seem to be trying to narrow it gradually through appeals.
the ironic thing is Lloyd's VAT recovery generally in the market VAT recovery has gone up from about 45% to 75% in that time. So when VAT does get charged to the market, on balance, we might be better off.
Yeah.
That's certain.
Unfortunately, the UK motor and home insurers won't be quite so.
No, I don't think they will. Or life insurers.
it'll change the way the claims handling industry works in the UK, really, won't
Yeah.
it? It'll have to.
Be much more in-house stuff.
Yeah. But anyway, watch this space on that one. So basically, yeah, just some pointers. It's a good idea when you're writing a contract to work out whether the VAT on any claim is going to be recoverable by the insured. Not only because it gives you the sum insured, you know, it can reduce the premium if you don't have to insure yourself for the VAT, because that's going to be recoverable.
An interesting point. Your first point, surely, is consider who the policyholder is.
Yeah.
So if you've got a global policy, why have the UK parent as the policyholder? Why not have their US subsidiary, who's very much involved in the risk management, etc., good reason, to be the principal policyholder? As far as I see, there's nothing to stop people doing that.
No, that's right. HMRC might say that the costs are charged back to the subsidiary or whatever it is. I mean, it's a bit like the Gibraltar scheme, really, that you're suggesting.
Right,
that
it's nothing like that.
one can't say Gibraltar anymore in VAT and insurance. But yeah, I mean, it is important at the outset to consider who the insured is and what their VAT position is. And, you know, what location they're in as well. So, yeah, good point. Think about claims handlers and loss adjusters and how you're going to do them. Are you going to give them delegated authority? Obviously, there are commercial issues around that as well as just VAT issues. So you don't do it just to get the exemption from VAT. And then when you do suffer a loss, consider whether you're actually paying VAT correctly, because even if you're eligible to recover it because the policyholder is non-EU, if it's not correctly charged in the first place, then you lose it. HMRC will refuse to repay. So you have to make sure that's right. And then the invoicing comes last. A lot of people think that as long as you invoice the insurer, then that's okay. They'll be able to recover the VAT. It's non-EU policyholder. But that's not necessarily the case. The supply has to be to the insurer as well. So you have to make sure that that's the way you have structured the insurance contract to begin with, rather than having a cost of the insured. So if it's a cost of the insurer, I suppose you'd call the contract a benefits in kind contract, which is probably not that common these days. Which
It's more personal lines, that. I mean,
yeah.
We don't generally buy and sell oil rigs and stuff.
No, quite. Yeah, but even in personal lines, I think it's less common. HMRC tend to accept that the car repair or whatever it is applied to the insured, but I'm not quite sure that's right, actually.
I remember they got their knickers in a twist about avoidance and insurers bringing car repair organisations in-house to avoid the VAT on the labour side on those costs. Again, I must admit I don't understand that, because it's a natural thing for an insurer to do, to control costs.
Yeah.
They bring it in-house and they think they can make some money out of it as well. But then the anti-avoidance officers in customs, I don't know, they feed them.
I don't think they've got anything better to do, but it probably indicates that if you do start to bring claims handling in-house, if it becomes taxable,
They'll see that as tax avoidance,
Yeah.
definitely.
Yeah. Right. So I've got some examples here, but we're getting a bit close to the end, really. Unfortunately, I haven't given you these slides, but we'll send them all round afterwards. I was thinking we might discuss the non-EU stuff a little bit more. But I think what we have shown is that is complicated. And it not only varies by jurisdiction, but also, you know, for insurance. Sometimes it's subject to VAT, sometimes it isn't. Even in jurisdictions which tax insurance, generally they will exempt life insurance. So that makes things very difficult for the insurer, particularly if they're writing both types of business. It's exempt in the EU for the time being at least, and it looks like with the withdrawal of this proposal for a directive, that's not going to change anytime soon, which is probably good news. as I think we've probably demonstrated with those non-EU countries. I suspect the IUA will continue to campaign for it, but I'm not sure how many people are listening, to be honest. Have you got a view on that, Nick?
Well, I never supported their position. So. No, I think there are too many examples of just how complicated it can get when you start charging VAT on general insurance. If you want a clean way of taxing general insurance, premium tax is the way to go. It's a shame we have to do with partial exemption, but the devil you know, and let's face it, you can have lots of fun with partial exemption. So.
And as I say, I mean, if you do have a group that's writing long-term insurance as well as short-term insurance, general insurance, you're probably going to be partially exempt anyway.
Well, no, everyone's going to be partially exempt for writing general insurance.
Yeah, possible. So, yes, if you're based in a jurisdiction which doesn't have any VAT, not many of those left actually, but obviously you can avoid input VAT, so you can have the costs billed to you. This is the Gibraltar situation, no VAT in Gibraltar. And there won't be any VAT because it's reverse chargeable potentially in that country, unless it's land related or some of the other exceptions occasionally from the services. If you're EU based, however, you're not going to be able to avoid VAT on services. It's going to be reverse chargeable even if the supplier's not in your country. But then you need to look at whether the policyholder's incurring the costs and can recover the VAT.
You've not mentioned Canada.
I haven't.
I don't know if anybody has a Canadian branch, virtual branch. The Canadians have got this legislation in relation to GST, where even though insurance is exempt from GST in Canada, they want to make those parties who are writing from outside of Canada into Canada, i.e. insuring Canadian risks, subject to the same sort of restrictions that their domestic markets suffer. So they've introduced effectively a reverse charge. So you have to look at your expenses, determine whether they're going to be would have been taxable for GST purposes in Canada, and you would have suffered a restriction, and then apply that restriction to you, even though those expenses aren't Canadian expenses; they relate to your Canadian business. And it's a nightmare. It's absolutely incredible, but it's another example where a tax regime or tax authority has looked at the basic principles which apply to their domestic market and said, well, if we're allowing these foreign insurers to write into our country, we want them to suffer the same costs. And there is an argument because, effectively, if you are writing Canadian business as a UK insurer, you have full recovery in relation to all your expenses, your overhead costs, your IT and everything, whereas the domestic insurer doesn't. So there is an element of logic, but then you get into the detail of the thing, and it's a nightmare. Then you put Lloyd's on top, and it's just complete chaos. But anybody with a Canadian virtual branch, they'll be coming for you soon. And also, there's no limitation here. If you haven't put in a Canadian GST return, they can go back to Noah's Ark.
And they're really that far? I thought it was 6 years ago.
Nope. If you haven't put a return, there's no statute of limitations. And oh, by the way, this was introduced in 2010. It was being discussed. Introduced in 2010. They issued guidance later on. They backdated it to 2009, so it has retrospective effect. Also, I've been advised that if the Canadians find that their legislation doesn't quite work, and it certainly doesn't quite work, then they can tweak it, and they can tweak it, and they can make that retrospective. So even if you come up with a cast iron argument why tax doesn't apply, if the Finance Ministry doesn't like your argument, or doesn't like your concept, so it doesn't achieve what they wanted to achieve, they'll just go back, change the law retrospectively. So just get your checkbook out when you go to Canada and
yes.
write a big check.
It's horrendous, isn't it? Good. Thank you very much. I think that's it.